Picture this. You wake up one morning, open your phone, and realize that intelligence has quietly become a utility, like electricity or water. Except instead of a public grid, it's run by a small handful of companies that own the data centers, the chips, the cloud, the models, and the distribution. And if you don't own a piece of that stack, you don't own the money faucet. That's the uncomfortable direction we're heading in right now. Not because AI is evil, but because of how the economics of AI work. AI is one of those rare technologies where the biggest advantage isn't genius, it's scale. Massive upfront spending, massive data access, massive distribution. And once you have those, you can compound your lead, while everyone else rents intelligence by the month. So in this video, we're answering a simple question. Why is AI wealth concentrating into fewer hands? And by the end, you'll see the same pattern repeating over and over. In chips, in cloud, in training data, in venture capital, and even in the way AI boosts productivity. The gains don't naturally spread out, they naturally pool. Let's start with the most visible money magnet in the AI era, compute. If you want to build cutting-edge AI, you need a ridiculous amount of hardware, and the company selling the picks and shovels has been printing numbers that would have sounded like science fiction just a few years ago. In NVIDIA's latest fiscal year results, it reported about $215.9 billion in annual revenue, with the data center segment bringing in about $193.7 billion. Net income was reported around $117.0 billion, with gross margins north of 70%. That's not a company doing well, that's a wealth pipeline. And it's powered by one main customer group, the hyperscalers and frontier AI labs buying mountains of compute. Now, why does this concentrate wealth? Because compute is expensive, scarce, and increasingly strategic. If you're a small company, you don't casually decide to spend billions training frontier models. You can't. If you're a big platform company, you can, because you already have cash flow, existing enterprise customers, and distribution. The rich can buy more capability, ship more products, get more usage, and then buy even more capability. That's the compounding loop, and the spending is accelerating. Goldman Sachs research has argued that AI-related capital expenditure is ramping hard, and that consensus estimates have repeatedly underestimated how fast it's growing, with expectations pointing toward AI investment potentially topping $500 billion in 2026. When you're talking about $500 billion a year, you're not in startup land anymore. You're in nation-state infrastructure land. And here's the catch. When the cost of entry rises, the number of serious players shrinks. Now let's move one layer up the stack. Even if you don't own data centers, you can rent data, compute. But that rental market is also concentrated. Synergy Research Group has reported that Amazon, Microsoft, and Google together, in other words, the landlords of compute, are mostly 3 companies. That means a huge portion of the AI economy has a toll booth. If you're building an AI product, you typically pay for cloud usage, which means you're paying rent to one of the giants. Then when you scale up, you pay more rent. And at the same time, those giants are building their own AI products that compete with you. So the AI market starts to resemble a casino, where the house owns the building, the chips, and the security cameras, and you're hoping your little table in the corner makes you rich. Now you might say, okay, but surely value will flow to the app layer. People will build products on top and get rich too. Sometimes yes, but here's what usually happens. The biggest winners at the app layer are the companies with built-in distribution, operating systems, browsers, office suites, app stores, search engines, and social platforms. Because in AI, distribution is king. The best model doesn't win if nobody uses it. The winner is the model that's embedded into the daily routine of billions of people. And this is why AI wealth concentrates into fewer hands. AI doesn't just create products. It creates platforms, and platforms concentrate. But there's another factor that's even more overlooked: training data. High-quality training data is getting more expensive and more restricted, especially as publishers, platforms, and data brokers realize they're sitting on oil fields. TechCrunch reported that the market for AI training data is expected to grow from roughly $2.5 billion to close to $30 billion within about a decade. That's not just a new market, that's a new gate. And who can afford to pay those gates at scale? The biggest companies. This creates a second compounding loop. Companies with money get better data access, which helps them build better models, which helps them attract more customers, which gives them more money, which helps them buy even more data. So even if a smaller team has talent, they hit a wall that has nothing to do with engineering. And speaking of walls, training frontier models is brutally expensive. Fortune reported that Anthropic's CEO Dario Amodei suggested models costing over $1 billion were imminent, and warned that training costs could climb dramatically into the multi-billion range. In that world, competition starts to look like a club. And here's where people get confused. They think AI is democratized advertising because you can download an app and type prompts, but access is not the same as ownership. If you're paying a subscription to use AI, you're not sharing in the upside. Now let's talk about venture capital, because this is the fuel that decides who even gets to try. The OECD published a February 2026 report on venture capital investments in AI through 2025, and it paints a very concentrated picture. It reported that the United States accounts for about 75% of global AI VC deal value, around $194 billion, while the EU 27 was about 6%. It also notes that VC investments in generative AI reached about $35.3 billion in 2025. So even the startup funding story is concentrated geographically and structurally. A huge share of capital, talent, and deal flow is pooling into one ecosystem. And within that ecosystem, the biggest checks are going to a relatively small number of frontier players. And to see how extreme the top end can get, just look at what happens when a frontier lab raises money. In late February 2026 reporting, multiple outlets described OpenAI raising an enormous funding round led by major tech and finance players at a valuation measured in the hundreds of billions. Whether you love or hate that company, the signal is clear. AI is becoming a mega cap game. The result is predictable. When the capital requirements explode, ownership concentrates. When ownership concentrates, returns concentrate. Now here's the part where we zoom out to the whole economy. A common promise you hear is AI will boost productivity and create trillions in value. McKinsey has estimated that generative AI could add about $2.6 trillion to $4.4 trillion annually across a range of use cases. That's enormous. But the key question is, who captures it? The IMF has been blunt about the distributional risk. In its 2024 staff note on AI and the future of work, the IMF argues that AI can increase inequality through multiple channels, including the idea that if AI complements high-income workers more than others, wage inequality can rise, and that increased returns to capital can increase wealth inequality. That's economist language for something very simple. If AI makes capital more productive than labor, then capital owners win. And who owns the capital in AI? Not the average worker. It's shareholders, founders, and the owners of the compute stack. This is why AI wealth concentrates into fewer hands, even if AI makes society richer overall, because productivity gains don't automatically become wage gains. Sometimes they become profit margins. Now let's make this tangible with a quick analogy. Imagine you build a bakery. AI makes your bakery more efficient. You can design marketing faster, automate ordering, forecast demand, and reduce waste. Great, but to do that, you pay subscriptions for software, cloud usage, maybe an AI agent that handles customer support. That money flows upward into a small number of companies. Your bakery might become more productive, but the AI rent is paid to the stack owners. Scale that across millions of businesses and you get an economy where small and medium companies become more dependent, not less. And it's not just businesses, it's countries. If the infrastructure and model ownership is concentrated, then smaller economies risk becoming permanent renters. They get the tools, but the dividends, profits, patents, high-end jobs, equity growth, flow outward to the hubs that own the stack. So, what do we do about it? Well, if you're hoping the market will magically distribute AI wealth evenly, it probably won't. Concentration is not a bug here, it's a feature of how AI is built and deployed. But that doesn't mean the outcome is fixed. There are a few levers that can widen ownership instead of widening the gap. One is competition policy. If cloud and model distribution become too concentrated, so smaller players aren't crushed by vertical integration. Another is public compute. If governments can fund shared infrastructure similar to research supercomputers but scaled for startups, universities, and public interest labs, you reduce the only big tech can play problem. Then there's data governance. If training data becomes an extraction economy where platforms monetize society's digital exhaust without sharing the returns, you can imagine licensing frameworks or collective bargaining for data rights, especially for publishers and creators. And finally, there's worker leverage. If AI boosts productivity, then workers and communities need bargaining power through skills, unions, profit sharing, or even ownership, so the gains don't only show up in stock buybacks and executive pay. Because at the end of the day, AI for everyone is not the same thing as AI wealth for everyone. If AI becomes a utility, the question is, who owns the utility? So here's the question for you. Do you think AI will become a world where everyone gets richer, or a world where most people rent intelligence while the owners of compute, cloud, data, and distribution quietly collect the dividends? Let me know what you think in the comments. If you enjoyed this style of deep dive, hit like, subscribe, and turn on notifications so you don't miss the next one. And if you know someone who thinks AI wealth will automatically spread out, share this video with them, because the economics matter just as much as the technology.